interesting. Okay? The first is the idea of financialization. And this theory is proposed by an economist, a French economist named Thomas Piketty. Okay? And he wrote a book called Capital in the 21st century. It is a fantastic book. You don't have to read the book, but if you have a chance, you should definitely pick it up because it is a very easy but very illuminating read. And what he argues is that what happens in society is that capitalism transitions from phase to phase to phase. In the beginning, you have consumer capitalism, meaning that what the society is trying to do is create goods that consumers want to buy. This is an era of rapid wealth generation. Then you move into financial capitalism, which is a period of investment. Rather than build factories, you put the money into the stock market. Okay? So you're trying to generate as much money as possible. But what we discussed last class that's very important is wealth and money are not the same thing. So in the first phase, consumer capitalism, you focus on the generation of wealth. In financial capitalism, you focus on the generation of money. And then you move on to monopoly capitalism, which is where just a few companies control everything. And we live in an era of monopoly capitalism. And this happens because it is much more profitable for companies to be monopolies than to be in competition with each other. Financial capitalism is looking to create as much money as possible, not as much wealth. And so a few companies come to dominate, become monopolies. And that's the age we live in today. Okay? Now, why is this important? It's important because when we make this transition, people are no longer focused on working hard. They're only focused on speculating. All right? So let me give you an example. Let's just say I'm an entrepreneur and I want to make as much money as possible. Well, what I do is I build a factory. When I build a factory, I'm creating real wealth because a factory requires you to hire workers. It requires you to build technology. It requires you to build goods that people want to buy. But after I build a factory and I make a lot of money, I want to take this money and let it grow as fast as possible, so I put it in a stock market. Okay? And that's just how people behave. The problem is that if too many people do that, then no one's really working. No one's creating real wealth in the economy. The other problem is that because of the way capitalism is set up, if everyone's putting the money in the stock market grows too fast. And the real economy does not grow that fast, okay? And the difference is stark. Thomas Piketty spent a lot of time going over income tax, just looking at how much tax people paid. He did a lot of statistical analysis. And what he discovered is the real economy in late-stage capitalism will grow about 2%. The financial economy will grow at 5%. Okay? And this is really key. What this is telling us is that if you have $1 million, you could choose to go and open a restaurant, or you could choose to invest in the stock market. If you open a restaurant, you will make at most $20,000 a year. But if you were to put in the stock market, you would make $50,000 a year. So everyone's going to put all the money in the stock market, which allows for the stock market to increase. But the real economy is not improving. And therefore, you have all these issues arise. greater unemployment, greater debt. No one's really working. Okay? So that's the idea of financialization. And what Piketty argues is that this is just a natural cycle. This is just a natural byproduct of capitalism. We live in an age of late stage capitalism. Is this clear to you guys? Any questions before I move on to the second theory?